Here is actual tangible proof of a collateral shortage. Everybody's been talking about RRP for the past few years, and we've just seen it absolutely skyrocket, going all the way up past $2 trillion per day. But what is the actual yield on RRP, and how does this affect the actual collateral market, which is one half of every single transaction on the planet? So the offering rate on RRP is 2.3%. That is supposed to be an effective floor on the market of any sort of treasury, because if you can get risk-free asset from the Fed for 2.3%, why would you take risk and go for anything lower than that? But we can actually see the 4-week T-bill is trading below RRP. And it's not just trading below RRP. We are currently trading 15 basis points below RRP. That is signifying a massive collateral shortage. Here on this chart from Jeff Snyder, we see repo fails here going absolutely skyrocketing during the peak of the COVID crisis. Now, what's happening now? We see almost even higher repo fail to deliver.
Josh, what I find interesting about the chart is that we have almost approached the peak of where we were at in the COVID crisis. But the second thing is, instead of the sharp spike that we saw back during the COVID crisis, we see the slow, steady marching up. I don't know what to make of that, but that seems to me that there's more of a systemic issue than a one-time thing. A one-time thing being, oh my God, we need to figure out to do something, thus the spike. But when you have the slow, gradual, methodical up of higher highs and lower lows, that seems more problematic, more systemic.
Yeah, and something else that we're seeing is, I mean, you would not want to be comparing the current financial system to what we saw during March of 2020 when we shut down the entire global monetary system and we froze almost absolutely every single transaction in the world. And we are seeing those exact same levels today. And as Justin was just alluding to, is we are not seeing this spike. We're seeing a gradual rise in risk levels. That is just extreme, like a tug of war situation, that where people need this collateral. People do not understand how important collateral it is. You see all over the mainstream media saying that bond prices should be out of this world. Yield should be at 40% because inflation's been skyrocketing out of control. But they don't understand that the intangible value that is catastrophic to the financial system that treasuries provide with the way that the current plumbing of the financial system works today.
Yeah, and the second thing too is when it gets to a collateral scarcity or collateral shortage, you get a huge hat tip to Snyder and his colleagues on talking about this. But if you have yields rising, and in other words, if people saying, listen, I have cash, that is retail, I have cash, I know what to do with it. Well, I might as well buy a bond or whatever, right? Because at least I'm earning 2.3 or whatever the rate is on it right now. This is just going to exacerbate the demand for treasuries, which are already in short supply. So you have what I assume to be financial institutions, that they need to have these treasuries on their balance sheet as collateral. But now all of a sudden, there's not enough of them to go around for the financial guys. And now you have retail coming in, or potentially have retail coming in and buying up treasuries due to the increasing in yields. Now we'll see if this changes or this eases off, if the Fed takes its pedal, or if the Fed backs off the gas in terms of raising rates. But for the time being, the takeaway assumption is that retail is now putting additional demand for an already constricted supply of treasuries. Someone once said macro happens on the margins. And my point is that if you have the yields on bonds or treasuries going up, what that means is that you will have more people on the margin who will be incentivized to buy this. These people on the margin who do opt to buy it, even if, let's say, retail's not jumping in wholeheartedly to treasuries, why would they if they're guaranteed to lose money? But the point is there will be additional buy pressure that's brought in on the margin because of this. This additional buy pressure on the margin will put additional demand on an already constricted supply of treasuries.
And then we can see from this chart from the Fed funds, I mean, everyone's talking about the Fed raising rates to infinity and beyond now, but let's actually just look at the downward sloping line of the Fed funds. Every single time the Fed funds has raised rates since the massive rate hike in the 80s, the Fed has not been able to maintain and raise rates above the previous high. We see now, if we look at a real-time chart, the Fed has just raised rates above the 2019 high. But what does this entail? I mean, this is signifying that if history has been a prover, that they will not be able to raise rates too much further past this. We can see this even in the Eurodollars futures market, where they're predicting that the Fed will not be able to raise rates past anywhere from December to February of this upcoming year. The reason for this is because the massive amount of debt that's in the system, and the more debt there is from the corporate to the governmental level, the higher interest rates go, the less of a likelihood that the businesses and the government will have the money to pay it back. Therefore, you have to continuously lower rates to maintain the constant pushing back of the years of malinvestment through government intervention and Fed backstopping these markets. And this is just kind of proving that there is no actual free lunch. It doesn't mean that it's coming to fruition right now, but the years and years of malinvestment that the government has caused is going to catch up to us someday. And with all the collateral issues that we are seeing today, it seems like that day could be coming soon. Thank you.